Stocks are looking pretty good on these strong earnings we're getting in, AI optimism, but subtle inflation signals and shifting consumer sentiment could soon reshape the entire economic narrative. But who cares? Because stocks notched another all-time high with the NASDAQ 100 reaching its 11th record high of the year, the S&P 500 reaching its 10th record of the year, and overall stocks are thought to be trending up mainly due to this earnings optimism we've been getting this week. We've had beat after beat after beat. It's like a rap song out here. Charles Schwab and Interactive Brokers beat earnings, mainly shouting out the trading revenues they've been getting in. Trading has been juicy for them lately. 3M, American Express, Netflix, Pepsi, TSMC, Broadcom, the big banks, all beating earnings, providing positive earnings numbers, positive forward guidance, and stock upgrades are coming in from analysts. So it's looking pretty good. And on top of that, when we heard from the banks, they were pretty positive about what they had to say about the economy being resilient here in the United States. But note that they did see weakness in the commercial real estate space, focusing mainly on office space, which they do have exposure to through their loan portfolios. But all of that aside, Charles Schwab was proud to announce that trading revenues are up. A lot of people are trading. They've opened up 1 million new accounts. So a lot more people are interested in investing and growing their wealth, or at least just trading and losing money. But at least for the investors who are in the markets for a longer time horizon, there's a lot of optimism around big tech and its influences on the market as far as it adopting AI, which will juice up their margins and that will make their valuations look better and save costs, all helping them fundamentally. And note this, on July 23rd, the Trump administration is set to release their AI plan, which is expected to help advance the United States as a global AI leader. And who would the main beneficiaries be in this case? Well, big tech companies, the ones with all the dollar hollers. So if they start pouring more and more money into AI and having more breakthroughs, that allows them to become more efficient and allows them to save money. And then when more people are like, oh my gosh, like Nvidia, wow, like you're making a ton of money, let's go buy this stock. Buy. And when Nvidia heads up and some of these other big tech beneficiaries of AI, when all of them are going up, that pulls the broader market up systemically with them. But that's kind of where the troubles start kind of showing through the cracks, because market breadth is still a concern for many people watching. By market close on Tuesday, the S&P 500 reflected some suspicion somewhere, be it the tariff-related news in regards to the August 1st deadline, inflation, or margin. Only 49 of the 500 S&P 500 stocks ended out in the green territory. And although 2 of the 3 concerns look pretty decent right now, remember tariffs, inflation, and margin, tariffs aren't really looking good because we don't know what could happen with that. And taco is what a lot of market participants are leaning on. But I don't know, like Trump's made it pretty clear August 1st is the deadline. But overall, it's looking pretty good. But there are more people noting further ahead, like in the coming months, it could start getting a little bit scary with more calling for weakness in the stock market through mid-October or even later on into this year. Jeff Bezos also sold $1.7 billion worth of Amazon stock. So some people are like, oh, is he trying to get out early? But if later on this month we start seeing misses or bad data, or maybe taco isn't necessarily a taco, it's a burrito, rip to the stock market, and maybe this trend up doesn't last for very long. But despite inflation not being terrible from the CPI and PPI reports, we did see this week that it did trend up further away from the Fed's gauge of 2% inflation, or at least we're expecting to see that when PCE comes out. And that trend is a sign that inflation is going up, and that's not what the Fed wants to do. So let's look at this. The 5-year break even what this really says what it shows is inflation expectations and the 5-year break even rate. So let's just back up a little bit. CPI and PPI showed inflation trending up. This 5-year break even, this 10-year break even, what they show are inflation expectations. And on this graph, we see overall, since the beginning of July to where we're at right now, it's trended up. So with that hovering where it's at around like this 2.53% figure that the 5-year break even sitting at, when it's above 2.5%, that's a signal of fear that there's this sustained upside of inflation risk. And the 10-year break even sitting at around 2.43%, in the 30-year break even rate sitting around 2.37%. The trend's up on these, and with all of them trending up before Trump really pushing this trade war with European Union pushing for this 15 to 20% minimum on the goods from the European Union, who knows where these could go even in the future. But I mean, on the other hand, that doesn't tell the whole story, because there's mixed confusion around these. So the break-even rates are expecting inflation to at least increase pretty soon. These are longer-term inflations. But the Treasury yield, so the Treasury market, on the other hand, which also gives insight into inflationary expectations, we see that this has fell a little bit this week. So let's put it on the 5-day if we could pull it up real quick. Sitting at 4.42%. And although it hasn't fell like a ton, it has fell a little bit. And this could maybe be on the news from Chris Waller that we got, who supports a cut this month. And we'll get into that. But where do we end up is what everybody's trying to figure out. Now, tariff-related inflation, let me move the camera back over to me, will either be a one-off or it'll be longer-lasting inflation, spelling out uncertainty, leaving the Fed officials to really guess what they need to do. And this gets into Chris Waller and what he was talking about, because pretty much to sum up what he sees is that he supports a cut, and the reasons for supporting a cut at their July meeting, just at the end of this month, right around the corner, is because he sees, first, tariffs are a one-off increase in the price level and do not cause inflation beyond a temporary surge. His second reason is that real gross GDP was likely only around 1% in the first half of this year and is expected to remain soft for the rest of 2025, which is much lower than the FOMC's estimates of longer run GDP growth. Meanwhile, the unemployment rate is 4.1%, near the committee's long-run estimate, and headline inflation is close to the target at just slightly above 2% if we put aside tariff effects that I believe will be temporary. So he's noting, hey, tariffs are likely to be temporary. We're expecting GDP, which is the country's scorecard for the economy, to really come in low. And taken together, the data implies that the policy rate should be around neutral, which the median FOMC participants estimate is 3%. And that's not where we're at. 1.25 to 1.5 percentage points above the 3%. So he's saying we're 1.25 to 1.5 percentage points above where we need to be. So he's saying we need to cut, in layman's terms, we need to cut 1%, 1.25% to 1.5% from where we're at. And then his final reason for favoring a cut is that while the labor market looks fine on the surface, once we account for expected data revisions, private sector payroll growth is near stall speed. We should not wait until the labor market deteriorates before we cut the policy rate. So he's noting that he supports a cut, and he's maybe applying for the job a little bit with Trump because Trump wants them to cut rates. He said that he's willing to accept the job if it's offered to him, but he's arguing the economy is weakening and will continue that trend, pointing out that slower economic growth and the labor market is softening and doesn't see inflation sustainably spiking up and being sticky. GDP growth only at 1%. And note this, in the last half of 2024, so last year, we were at 2.8%. So that's quite down from where we were last year at the same time. But note that Chris Waller is a minority among the Fed officials who support a cut. Most of them are more so leaning, if they do want to cut, they're leaning for at least September for cutting rates. So Chris Waller's for sure got the unpopular opinion. Now let's see if or how this has moved. Not really. I mean, it fell a little bit. I believe this was like 97% yesterday, so we're at 96% as far as a Fed cut probability for July 30th. What about September? 50. So, wow, even because yesterday I believe this was like 51, it fell a little bit. Wow. Wow. So I'd imagine this would be on the this could be on the Genius Act passing, which we're about to get into that, or this could be on the consumer sentiment survey that we got, or even the residential home housing starts, which I don't know. It could be a mixture of everything. So let's look at this. So in other news, the Genius Act has passed and been signed into law by Trump, being a huge win for crypto regulation around stable coins and how they can possibly help lower interest rates. And I thought this was interesting reading it. So let's get into it. So on Friday, Trump signed the Genius Act, which aims to regulate the issuing and use of stablecoins like USDC and Tether, which are pegged to the US dollar. So that's mainly the point of stablecoins, is that they are pegged to the US dollar. Crucially for Trump, the hope is that stablecoins will become a major buyer of short-term treasury debt. All right, that's pretty interesting. Trump's signature budget law that passed in July boosted the U.S. debt ceiling by $5 trillion, is estimated to add another $3.4 trillion to the U.S. deficit over the next decade. This will increase demand for U.S. treasuries, lower interest rates, and secure the dollar status as the world reserve currency for generations to come. The reserve currency is so important. You know, if we lost that, that would be like losing a world war. So, yeah, it's kind of looking good as far as, all right, crypto's getting more built into the economy and financial space here in the United States. So crypto lovers love it, and the possibility that it lowers interest rates, maybe it's inflation inducing, which goes back to the CME Fed Watch tool, and possibly could explain this slight drop in the expectations of a Fed cut, because we're back to almost 50-50. 2.1% of a 50 basis point cut. But back to this, there are still concerns that align with this bill, and let's get into this. So, why banks are on high alert with stablecoins, and I thought this was interesting. So, wait, there's more. A major issue for banks is whether stablecoin issuers will lure away customer deposits, and customer deposits are huge for banking. I work at a bank and I see it. I see the reports. That's literally like accounts, deposits, and loans. That's what banks really watch. A Treasury Department report in April estimated that stablecoins could lead to as much as $6.6 trillion in deposit outflows, depending in part on whether issuers could offer yields similar to bank accounts. And look at this. Take crypto exchange Coinbase, which offers 4.10% reward rate for customers that hold the popular USD coin known as USDC. So that's pretty competitive to these CDs that banks are offering. Now, this is where some of the concerns come in though. Stablecoins could lead to higher amounts of uninsured deposits at banks. If a customer takes money out of the FDIC, the Federal Deposit Insurance Corp backed account, and buys stablecoins, the issuer of that coin might end up putting the customer's money back in a bank account, albeit a higher balance account that is above the $250,000 limit for deposit insurance. A shift so less likely to be insured because there's this $250,000 limit. Yeah, you could like play around with it, put it into a trust and stuff, but that only increases the limit so much. Like you'll have to have a bank, you'll have to have like unlimited banks to secure everybody's money. Other than that, a shift by customers or consumers away from holding money in traditional bank deposits could have broader economic implications. Banks inject customer deposits back into the economy through loans to companies and consumers. If consumers move money away from banks and into stablecoins, it could impact banks' ability to do lending. And lending is how money is created out of thin air, because you borrow money, you pay interest, and then you pay the loan back. And money was created in that process. The Fed system gives banks access to extra cash in the event of market stress. The trade-off for banks are costly liquidity requirements, which don't currently apply to stablecoin issuers. Non-bank stablecoin issuers could sap deposits from banks and simply invest them for their own benefit rather than use them to help fund loans that benefit banks, borrowers, and the economy as a whole. So I'd imagine, with people wondering about this and the concern around stablecoins and the skepticism, that as regulation continues to build, stuff like it's not going to stay the Wild West forever, but right now this is a major hurdle and a major question for a lot of people out there. Now, let's look at the broader economy, because we got some data. We got Michigan consumer sentiment data, from the University of Michigan. And Americans aren't necessarily confident about the economy, but they are less anxious and less worried in regards to the economy and inflation trends. So the University of Michigan Consumer Sentiment Survey for July coming in at 61.8%, reaching a 5-month high was the headline today. Inflation expectations dropped to an expected increase of 4.4%, which is down from 5%. So inflation dropped a little bit. The gauge for the state of the economy rose to 66.8 from 64.8 in June, so that's looking pretty good. And all of these will probably worsen now, though, that this August deadline's getting closer, this August 1st deadline that's been the spotlight holder recently. Earnings have been looking good, though, and that's the other spotlight that shares. But this survey covered June 24th through July 14th. So it did see Trump's threats in regards to how these tariffs will get enacted, and maybe people thought taco, but taco might not work out. And I keep saying taco. Maybe somebody's watching my video who doesn't normally watch my market updates. Taco stands for Trump always chickens out, and he'll either reduce the tariffs or they'll get walked back or temporarily delayed again. There's questions about whether or not he's going to continue doing that. Now, let's look at the real estate space, because this was some more positive data that we got today. And what we see is that permits didn't really change too much. They're sitting at 1.4 million. Home building through housing starts, so that's the main headline on this, rose to 1.32 million in June, falling mostly in line with expectations as well, but still 0.5% lower than a year ago. So although more people started building as far as builders go, it is it's smaller than that of last year, but people are starting to build and they're expecting demand to slightly begin to start picking up as we go deeper into this year, closer to the end of the year. And I bet that's maybe because a lot of people are expecting this sit around and wait to find out what happens to really go away. And I mean, it makes sense, because a lot of people are expecting Fed cuts in maybe not July, but September, maybe October, maybe December, but September and December being the main contenders, and that would possibly help out mortgage rates a little bit and allow more people to buy. But overall, that's what we got today. We got a busy week next week, and I'll cover a video this weekend covering all of that. But the NASDAQ and S&P soared to record highs on impressive earnings beats and AI-fueled tech optimism, yet behind the bullish headlines lurks troubling signs. Remember, Jeff Bezos cashing out on Amazon stock, weakening market breadth, and rising inflation fears, and lowering inflation fears. I guess it's kind of mixed, but with Fed tensions rising as Waller continues to argue for rate cuts, investors brace for critical choices. Continue betting big on AI-driven optimism, or brace for volatility ahead? Let me know what you're doing. how you feel about this market. What should I cover? What am I missing in these videos? And in the meantime, y'all, I'll see y'all next time.